Director at Abbott Downing, followed by Doug Sue. He's a multi-asset strategist over at QS Investors, Legg Mason, followed by Marcel Benjamin, he's Vice President over at SSGA, State Street Global Advisors. We're going to be focusing on the evolution of portfolio management and trends that we're looking at in the macro markets. It's great to have all you guys with us today. I'm going to go right down the line. Rob, let's get your outlook, a little bit of what's going on over at Abbott Downing, and I'll ask the two of you to do that as well.
Okay.
Sure. So we focus on ultra high net worth investors, generally portfolios of 50 million and up. And so we're focused on multi-generational, long-term time horizons. That tactical asset allocation is still really important. For example, in our portfolios right now, we're overweight US equities, where we just brought non-US developed from overweight to neutral. We're underweight non-US bonds, and we're overweight MLPs. So we have a multi-asset approach, and then we take these tactical tilts periodically. But because of our client base, those tactical tilts tend to be in place for multiple years as opposed to trying to catch some of the shorter term moves.
All right, thanks for joining us, Doug.
Yep, QS Investors, we're also big multi-asset portfolio guys as well. We take a systematic view. We build all types of multi-asset portfolios, but on a quantitative basis. Probably the biggest thing for us in terms of our overarching constant philosophy is the importance of diversification. And that for us comes at not only the asset class level, but also factor, style, manager level as well. In terms of where we are right now, in terms of a couple of tactical views, we do see that we think we are a little bit later in the market cycle, something that probably is more of a consensus view. But because of that, two areas that we really like right now. We still like equities, but we have more of a view on preferring defensive equities. So these are stocks that typically have a lower volatility, higher dividend than your average equity, and typically a smoother ride, but still getting that higher equity upside. And also we're pretty bullish on alts right now, liquid alternatives. These are obviously asset classes that can perform both in up and down markets. So we see that as a really good hedge for your traditional stock and bond portfolios.
All right, thanks, Doug. Marcel.
So I'm a fixed income specialist with the Spider brand of ETFs. And what we've seen recently is with the Fed on pause, a lot of investors have been putting money into spread products. A lot of interest in our high yield ETF. But just as well, some investors are still concerned about where we are late in the cycle. And ETFs really represent an opportunity to put money to work in all types of fixed income instruments. So we've had interest in emerging market local currency debt, given that we shouldn't expect the dollar to strengthen much more at this point in the cycle. And just as well, some investors are using our Treasury bill ETF to park their cash and still earn a decent return.
Well, it sounds like the common theme here is going to be risk management. Since the markets are at that inflection point, everyone's kind of concerned about the outlook with the Fed and how they're going to handle their interest rate policy. How are you tackling risk management head on?
So we have a very robust risk management protocol across the organization. We also partner with some of our sub-advisors. So risk management is paramount for the organization. And ETFs really offer investors an opportunity to enhance their liquidity if that's a concern for them as well. So it's definitely an important instrument in any risk management infrastructure.
Especially in the fixed income markets.
Absolutely.
Liquidity is key. Doug?
Yeah, risk management for us means a few different things. It kind of varies on the type of investor you are. For more of our institutional investors, our multi-asset portfolios typically will use some sort of dynamic risk management. This is where we're looking at quantitative signals in the market, as an example, elevated equity volatility as a signal to lower equity risks dynamically in a portfolio, and we'll do that by, let's say, shorting equity futures as an example. On the other hand, for more of our retail or advisor clients who, let's say, don't have the ability to use derivatives in their portfolio, this is where we really just go back to the basics and really just espouse the importance of diversification, particularly diversification in place before we see a large drawdown in the market. As we know, it's very hard to benefit from diversifying into different asset classes when the market's already going down.
Right, and diversification allows you to stay invested,
yep,
which is key as well. And I'm sure, Rob, that's something that you talk to your clients about too when managing risk.
Yeah, I think one of the other things that's important to us from a risk management standpoint is each one of the clients thinks of risk extremely differently. It's not an institutional mindset where risk is defined by volatility or standard deviation. For us, the client description of what risk means to them is really one of the first steps we try to take. And for each of our clients, it means something very different. For some, it means making sure that they have the capital to fund outside interests that they have. For some, it means being able to generate enough returns to make the charitable contributions they want to make. For some, it means offsetting some of the risks that might be inherent in their own family business. So for us, the risk management really comes down to what it means for each client.
All right, let's talk about technology and disruption within this space. Marcel, I'm going to throw it back to you. I mean, ETFs of all areas in the market has really benefited from technology.
Absolutely, and ETFs really have heralded the democratization of investing. So any retail investor can buy one share of an exposure on the exchange at the same price that an institutional investor could access that. I think it's never been the case that an investor can access so many different types of exposures. Again, emerging market local currency, something that would be very difficult otherwise to even get your hands on a bond in the currency of a different country. And today you can get that exposure in a beta index type of instrument and execute right on the exchange any time of day.
And it's like there's so many ETFs out there that it's almost the new stock picking, if you will, because they're so thematic. So Doug, when it comes to allocation, how has tech disrupted that?
It's a huge thing right now, and it means a little bit of a different something for asset managers. But for us at QS, and we're part of Legg Mason, which is a family and affiliate of an organization comprised of several affiliates. What we're doing at QS when it comes to interfacing with technology really is partnering with our financial technology affiliates, colleagues at Legg Mason, where we're looking at QS to do what we do well, which is to be able to provide our expertise as asset allocators and to use fintech companies as really the front engine to interface with different types of clients. And really what this means at the end of the day is that we think we're going to be able to provide much more highly customized, personalized investment outcomes for individuals. If you think about, as an example, your classic target date funds, they only really vary depending on how old you are and when you want to retire, not really what we would call a high degree of customization. When you think about interfacing that asset allocation device with technology, you're able then to take into account a number of other different variables that can, when considered, can greatly increase the probability of really meeting that investor's specific desired outcome. So that's where we see us moving into when it comes to the interface of asset allocation and personal technology.
All right, and Rob, so outside of the investment process, you also have to focus on management selection for your clients. What does that process look like? So
there are a lot of different factors that go into it. We have a profile that we like for most of our active managers. And I say active managers because we'll build a very cost-effective core using even some of Marcel's tools on the passive side, and then populate areas around that core with active satellite managers. The managers that we tend to focus on tend to be a little bit more concentrated, longer term time horizons. So a manager that might own 20 stocks in the emerging markets or 25 stocks in the emerging markets, 20 to 25 stocks in US small cap. Those are the types of areas that we'll try to populate around a cost-effective core. And so what we want to see is a demonstrated history of being able to pick stocks effectively and really manage taxes. For our clients that in most cases are paying taxes at the highest income level, that sensitivity around what kind of return gets generated by a type of investment is a critical component to understanding how the manager has been able to perform.
Now, how often do you change managers around? I would imagine there's an evaluation process that you look at quarterly or annually. You obviously want to keep consistent with who you have managing.
Yeah, so I would say, and it varies. Some of our managers we've had for 10, 15 years. They've had great track records. They've performed very consistently. They've stuck to their knitting, so we know what we're going to expect. We've had to, in some other instances, where we thought we had found the perfect strategy and the perfect manager. They've experienced either turnover at the senior management level or a change in philosophy, and we've had to turn them over. So, we've had instances where we've had to terminate a manager and less than 2 years. But for the most part, what we're really focused on is finding a partner that we can invest our clients' capital in over a multi-year period.
All right, and Doug, I'm going to throw it over to you now, strategy selection.
Right.
There's a lengthy process that goes into that as well, and how often do you stick with particular strategies?
Yeah, for us, strategy selection really comes down to thinking about what a certain investor needs to meet his or her outcome. So some investors are they just vary in terms of the risk tolerance. But a lot of other ones, particularly those who are using multi-asset portfolios, they're using them because they have a very unique desired investment outcome. It could be, for instance, a desire to generate high income with a low level of risk. It could be that they have a particular sensitivity to inflation. So really, we pick our strategies with one, diversification in mind, knowing that over the long term, you should probably be allocated to many different types of strategies regardless of the market environment. But then we tend to tilt tactically more towards certain strategies in certain environments and to increase the likelihood of meeting an investor outcome depending on what that investor needs. So again, for let's say an older investor, somebody close to retirement, we may tactically shift their portfolios more into high income generating strategies.
All right, and Marcel, we touched upon this before, but let's go back into fixed income ETF trends. I mean, the inflows are certainly there, but smart beta fixed income, it's just, like as you said before, adding more liquidity back into the market and giving managers more options, particularly in an environment like this. So let's learn more about that.
Absolutely. So, in fixed income, there are a number of different factors and a number of different ways to add alpha. You can go down in credit, you can extend in duration, you can sell volatility, or invest in more complex esoteric asset classes. And we have exposures around many of those types of fixed income sectors and strategies. And we really offer a number of different tools for investors. So we have a passively index managed ag exposure, and we also have an actively managed, to Rob's earlier point, we actually do have actively managed fixed income ETFs. So the exposures are there, and it's really up to the investors in terms of how they want to implement them. And the liquidity in the ETF market is additive and sometimes even better than you can get in those underlying.
All right, let's talk about some macro headwinds that we're facing. Of course, everyone's talking about U.S.-China trade. Clearly, we're going to be predisposed to that here. But Brexit, I mean, the headlines were pretty fast and furious this week, and it seems like a stepping backwards here. I mean, how does that impact, how you're handling your investments?
So it sort of factored into our recent decision to reduce the developed non-U.S. overweight in equities. We sort of went into that position because all the factors were there. Valuations were much more reasonable compared to U.S. stocks. Europe seemed to be behind the U.S. in terms of the recovery, the U.K. included. And so a number of those factors went into our overweight. Given the challenges associated with Brexit and our belief that the dollar really isn't expected to strengthen in a meaningful way, we've reduced that. And in terms of Brexit specifically, the only thing I feel like I've learned from this past week is that hard March deadline that was set 3 years ago is a lot easier to move than people had talked about in 2017, 2018.
Yeah, what's it, June now? I think
yeah.
June.
And I wouldn't be shocked if the June one gets pushed into 2020. I think it's just there's so much difficulty around coming to a consensus there that we don't see that as much of a hard and fast deadline.
Yeah. It sounds like a lot of buyer's remorse there, and perhaps it might just be me, but UK politics are incredibly tricky to follow and understand how the process works. But Doug, let's get your thoughts on Brexit as well.
Yeah, sure thing. We actually have a sort of a similar view. We're quantitative managers, so all of our tactical and strategic asset allocation decisions are model driven. What I can see right now in terms of the UK and really Europe equities in general is that we are starting to pull back in terms of our tactical overweighting of that. In fact, our model, which looks at tactically US versus international, now favors US equities over international developed equities. And largely that's on a couple of things. One, we're seeing European leading economic indicators starting to come in a little bit. Some of that is, we think, driven by Brexit volatility and uncertainty in the market. And two, we also look at options market data. Here is really what we call sort of the institutional smart money, if you will. And we're seeing a lot more bearishness in terms of demand for puts in international developed options markets versus the US. And that's another factor that's really fueling that, that call where we move tactically more in favor of US stocks versus international developed, of which obviously the UK is part of that.
All right, and Marcel, what does this look like for the fixed income markets
Well,
with either scenario?
Yeah, absolutely. Well, Brexit is certainly weighing on the global fixed income markets. We are now back to a point where more than 10 trillion of fixed income assets have negative yields globally. So that's obviously an important factor for investors. One thing I can tell you is that investors don't like uncertainty, and so once this is resolved, that should be supportive of markets.
Right, but even if the uncertainty comes out of the market, let's say a hard Brexit does go through, I find it really hard to find a bullish scenario out of that, at least the initial impact of it. I mean, it's going to change the entire global banking system. So.
Yeah, absolutely. I mean, that is an element of uncertainty that I think every investor is trying to deal with. And that, for us, is something that is really hard to capture in a lot of systematic models. And so we go back to this, and it's something I said before, but this is why we feel it's so important to have many elements of diversification in your portfolio and really to be thoughtful about not being overweight any particular factor, asset class, or country.
Right, because it sounds like if that happens, or if they do another vote, things kind of go on business as usual. But if you do get a hard Brexit, it's almost like a vacuum. Like, what happens the next day? So it almost, yeah, you get a decision, but I feel like there's even more uncertainty once that happens, because there is no plan B, as far as I know.
Yeah, and I think the component that accelerates that to the downside potentially is the fact that the ECB doesn't have a whole lot of tools to act if that were to create some broader global weakness in the region. So if there is a sell-off in Europe, and as a result of a hard Brexit and things soften up there from a macro perspective, the ECB hasn't raised rates. So they don't have the ability to cut a few times to sort of step in and bail out. So if there is a period in time post a hard Brexit where the macro environment no longer believes that the European Central Bank is in a position to provide support, I think that's going to accelerate things to the downside.
Right, and I think that's one of the reasons too why we feel like we're at this inflection point, because there's a lot of optimism priced into this market. I think we can all agree on that. What's next catalyst? Sorry, anyone take a guess?
Next catalyst in terms of what's going to happen this year?
Just next catalyst, and how do we get to like that next level in the market, if you will?
Yeah, I think something that everybody's looking for is really some element of stabilization of the market. Over the past year, I mean, I think what we've seen increasingly is really an increase in the fragility of the market. You see these really quick spikes in global volatility around the world, and markets seem to be hypersensitive in a way that they weren't necessarily in, let's say, 2017, where everything just seemed to be going up, up, and up. So I do think that really what we're searching for right now is, one, obviously some stabilization when it comes to the Fed policy. I think we're starting to get some better indicators on what that's going to look like. And then obviously all the other major countries in terms of their central bank policy. Once that starts to crystallize, I think we'll have a better sense whether the market is going to start trending back upwards, or maybe we're in it for a longer period of volatility and uncertainty.
All right. Rob, Doug, Marcel, thank you so much for joining us at the Nasdaq Market Site.
Jill.
And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.